Hey, what's up guys, welcome back to the channel. Hope you all are doing good. So after watching the last video, I'm sure you guys have now fully understood sales growth and the different aspects to sales growth, and you basically now understand how to look at sales growth from point of view of investing. So today we're going to go a step ahead and we look at how we can use sales growth to pick the winning stock from a specific sector or from a specific industry. And we'll also look at how you can use sales growth for P2P comparison, and this will help you ride the good stocks and cut the bad stocks early. After watching this video, I'm sure you guys must be fully equipped with all the knowledge that you need for understanding sales growth, understanding why sales growth is important in companies from point of view of investing. So on that note, let's start the video. So today we'll understand sales growth from an analogy of Formula 1 or F1 racing. Okay, you know in Formula 1 how there are different cars and different cars go at different speeds. Okay, similarly apply this analogy to stocks. Stocks grow at different paces, different stocks within a different industry grow at different paces. Okay, many times you must have seen key stocks within the same sector grow at different rates. One stock grows at high rate whereas the other one grows at slow rate. That is why market rewards this stock makes money, and this stock remains there forever. Okay. Similarly, in F1 how we look at it, we look at fastest car wins, right? Similarly in the stock market as well, we want to look at stocks that are growing at a higher pace. Now an important thing to note here is that this analogy, this car race analogy, this is only applicable to stocks within the same sector. For example, within the jewelry sector, within the fashion retail sector, within the capital goods sector, within all different sectors. Okay? So this is applicable to all the sectors, but only applicable to stocks within the same sector. You can't compare a automobile company with a pharma company or a IT company with a FMCG company. No, right? So you can only use this example for companies within the same space. For example, Wipro, Wipro, TCS, Infosys. You can compare these. Then you can use the Britannia, HUL, Colgate within the FMCG space. Okay. So once you've got this clear, we'll move on to how to actually look at it. Now you must have seen F1 racing, right? F1 racing में क्या, the car which finishes the race early wins the race, or the car which is moving at the fastest pace wins the race. Similarly, in investing, we have to remain with stocks that are growing at the highest pace within a sector. Understood? इतना समझ लिया, बस हो गया. ठीक है? This is it. This is all of today's videos summarized. Okay, so you only need to go for stocks that are growing at the highest pace within a sector. F1 में also we want to go with the car that is the fastest, and stock market में we want to go with the company that is growing sales at the fastest pace, right? Growth, as I mentioned in last video, we want sales ka growth. So let's take for example, there are three companies, right? First company is growing at 20%, second company is growing at 40%, and the third company is growing at 60%. Now tell me, out of these three companies, which company will you use for investing and to make money? Third company, right? Why? Because as mentioned in the last video, if company is growing sales at faster pace, means what? Company will grab market share. Company will means company product is better. Customers are demanding more of third company's product rather than these two companies, and market will always reward this company because this company is growing at higher pace. And as mentioned in the last video, money will chase growth. Okay, I'm sure you must have understood this, why we always want to go for the highest growing company within a specific sector. Now in today's video, we'll use the example of retail apparel space, and we'll do a P2P comparison on which stocks have made money and which stocks have not made money in the past 1 year or past couple of years. Okay, now an example, just ऊपर से example I'll give is gold loan company. Okay, gold jewelry companies. You look at gold jewelry companies whereby Titan has not made money in the past. Why? Because Titan is not growing at the same pace it used to earlier. Okay, the pace of growth has decreased, right? Once upon a time, Titan used to grow at 35-40%, but now Titan is growing at 20-25%. The market will be like, once you used to grow at a higher pace, now you're growing at a slower pace, I will not reward you. But if a company was growing at a slower pace, but now it is growing at a higher pace, market will definitely reward it. Okay, you look at any company, you look at Asian Paints used to grow at good rates, market rewarded. Asian Paints ka sales is degrowing, market is not rewarding it. As simple as that. Just keep it that simple. Just look at the sales growth. If sales growth is growing at a pace more than it used to grow in the past, then market will reward it. If it is growing at a pace less than it used in the past, market will not reward it. As simple as that. Talking about why we use P2P, we understood why P2P, because different companies grow at different rates within a sector, and you can never tell when one company might start slowing growly and when one company might start growing at a higher pace. That is why we actively need to track companies, right? I have mentioned this in the past video as well. We always need to consistently track companies, because one company that is growing at 30%, it isn't written somewhere that this company will continue to grow 30% for the next 10 years, right? it might be that after the next year company starts growing at 25%, then 20%, and this company that was growing at 15% might start growing at 40%. So you always must track these companies, because active investing is that you can't just be like, I've bought the stock, I am eligible to make money in the stock for 5 years if I hold the stock for 5 years. No, if you are in the right stock for 5 years, then only you will make money. Otherwise you are not entitled to make money just because you're holding a stock for long term. So what we understood, sales growth में we understood sales growth, and we understood with F1 analogy, car race company. ठीक है, imagine all the cars are in a race and money will always chase the car which is growing with the car which is the fastest, or the stock or the company that is growing sales at the fastest pace. We also discussed this reason: higher demand, higher market share, customer satisfaction, all of that. Okay, so if I just have to give you a brief example, you look at jewelry space. Kalyan is growing at around close to 35-40%, whereas if you look at Titan is growing at 25%, and then if I'm not wrong, Senco is growing at around 20%, and then PNG is also growing at close to around 15-20%. Now why? Look at it. Why Kalyan Jewellers made a lot of money in the past, right? Now I don't know why the stock is falling that much, but why the stock created money in the past? Because it was growing at a significantly higher pace than Titan, than your Senco, than your PNG, right? That is why it was making money. But going forward, if the pace of growth, right, give importance to the pace of growth. If the pace of growth slows down, then the Kalyan will not make money. Market will not reward Kalyan. Market will be like, if Kalyan is growing at 30% and Titan is also growing at 30%, I will reward Titan, because Titan has a good management. Titan has close to 1000 stores. Titan has a good market presence, good market share. Then market will reward Titan. But why market rewarded Kalyan more than Titan? Because Kalyan was growing at 40%, 35-40%, whereas Titan was growing at close to 20-25%, right? 20-25% is a good growth number, right? In different industries, 20% is a good growth number, right? But why? Because this car is at a faster pace. This will complete the race earlier. That is why market will reward this. And also one thing I forgot to mention in last video is that we never want to generalize anything. Okay, what I mean by that is, you must have seen ki companies with a good ROC of more than 15% are good companies. But that we don't have to generalize anything, because that is different for different companies. Company that is doing fresh capex, company that is starting out might have a low ROE, but doesn't mean the business is bad, right? Just how if a company is growing sales at 20% doesn't mean the company is good. Maybe one time the company was growing at 50%, now it is growing at 20%. So that is a bad company, right? On the other hand, if a company has a single digit ROE, that doesn't necessarily mean it's bad. If it's a turnaround company, then that is exceptionally good for me, right? So you don't have to generalize anything in the stock market. That is a mistake I did in the past, and this is something that you should avoid as an investor especially. Okay, so now I'm sure you guys have understood what we mean by the car race analogy, why we look at the car race analogy to find the different winners or to find the winning stock within a specific sector. Because when a sector does well, all the companies do well, but not all the companies make money. What makes money is the top 2 companies or top 3 companies that are growing at the highest pace. And if you guys are liking the video so far, make sure to like the video, comment down below what is the favorite part of this video or favorite part of this analysis. So today example, maybe look at the fashion apparel pace, and within that we'll look at 3 to 4 companies, and we'll also analyze what is going on with this sector, and we'll look at why some companies are making money, whereas one stock that has made money but has now down 50%. Within the sector we have 4 companies. First is V2 Retail, then we have V-Mart, then we have Bazaar Style, and then we have all favorite Trent. Okay. So first of all, let's look at why V-Mart. We'll just look at V2 Retail. Okay. If you look at V2 Retail has made a lot of money in the past. Okay. If you see, 900 रुपए का stock has gone to almost double हो गया stock, and within the last 3 years, if you look at it, stock is basically 20 times, right? 20 times within 3 years is not a joke. Okay. 20 years within the last 3 years, and now let's look at the reason why. If you look at profit and loss yearly, you look at what company has been consistently growing at 30. Company used to grow at what? 30%, 40%, now 60%. Now connect this with the earlier example I gave. Company was growing at 20%, but now company is growing at 50-60%. Market will what? Market will reward it. As you have seen here, market has rewarded the stock, right? You can see also P has expanded to almost, we'll look at valuation, you won't understand P, but just look at how market has rewarded. Why? Because company has consistently been showing sales growth. Okay, now give importance to words consistently sales growth. Look after 2023 how company has been performing, right? 25%, 20, 56%, 53%, 57%, 60%, 60%, 70%, 52%, right? Do you see how well the company has been consistently performing since the last almost close to 9-10 quarters, right? 9-10 quarters a company has consistently been growing at more than 40%, 50%, 60%. That is why market has rewarded the stock. Okay, remember this. Okay, and company as a company has any exceptional items, company has consistently performing well. Now don't look at the margin front, we'll cover margins in the second video, but now for example just look at the sales growth topic. Okay, look at sales growth, why this has been growing at a faster pace. Now remember, V2 has been growing upwards of 50% or close to almost 60% in the last 3 to 4 quarters, right? Now let's look at its competitor, which is V-Mart Retail. If you look at V-Mart Retail, what has happened? Once upon a time, company did make a lot of money, but now what has happened? Company is down close to almost 30-40% from its peak. Company also made from, like, if you see 2023, say stock almost doubled. But what happened? Why the stock fell again? Because if you look at it, company की growth has also reduced. ठीक है? If you look at it, 2023 में company used to grow almost 40-50%. Right? Now connect this with the early example I gave. Company that was growing at 50% is now growing at 20%. 20%, if you ask anyone, company is going 20%, is it good? People will say 20% is good. But once upon a time, company used to grow at 40-50%, and that is why market is not rewarding it. Why? Because now company is growing less than 20%. Okay, do you understand? And similarly, if you look at it, 2023 में company was good. If I just show it to you, 2023 से company started growing. If you look at it, 2023 में company was around 400. उधर से market rewarded it. It almost doubled. But if you look at it, sales growth, what has happened? Sales growth that were once growing at around close to 40-50%. Okay, so now what is happening? V-Mart Retail is growing at south of 20%. 20%. See, that is why I said do not generalize anything. Because if you look at it, you'll be like, oh, company is growing at 20%. Why is market not rewarding it? Because you fail to see that market company was growing at 40-50%. Now it is coming down. Okay, that is why if you look at it, V2 Retail has created more money than V2 Retail. Okay, now we'll take another company, for example, Bazaar Style. If you look at Bazaar Style Retail, Bazaar Style में भी क्या हो रहा है? Company it is growing okay, but company it is not consistent इतना. If you look at it, company used to grow at 2023 में this company started booming, right? All this fashion apparel space, they started growing. 2023 में what happened? The entire sector started booming and all these companies did well. But what happened after 2023? Only V2 Retail was still consistently growing at 40-50%, whereas these companies which were once growing at 50% have now come down to modest 20%, right? So market will not reward it. If you look at it, 2023 maybe company used to grow at close to 40-45%, and 2025 may also company showed good growth rate of 38%. But remember, who is the winner? V2 Retail is still growing at 60%. 60% and 40% there's a big difference, right? In F1 also we saw which car we want to bet on, the car which is at the fastest, right? In this example as well, we want to bet on which company? V2 Retail, which is growing at the fastest pace. Okay, now I'm not promoting any stock, or I'm not saying V2 Retail is a good company. If tomorrow going forward V2 Retail starts growing at 40% or 20%, I will be like, I don't want to any. Okay, if I have position in the stock, I will cut position in the stock. Because if company is growing 60%, now company is telling that we will grow at 40%, I will not be interested in the stock. There are more than 5,000 stocks, and it's not necessary that you have to stay invested in this just because you bought it. If going forward Bazaar Style starts going at 40%, maybe I'll exit V2 and then I'll put my money in Bazaar Retail. Okay, now I'm sure you guys must have understood this. So now let's look at the favorite company, Trent. Okay, Trent is a classic example of high sales growth and low sales growth. Okay, now just look at it. Look at it. I said कि 2022-2023 में the retail apparel space started growing. Look at it. Company was growing at how much? 73%, 83%, 50%. Okay. And if you look at it on quarterly basis, company was consistently showing 60, 53, 65, 45, 52, 50, 50%. Okay. Now, why? And remember this time. Okay, 2022, 2023, 2024, up to 2024 तक, ठीक है? If you look at it, 2024 the company was growing around 50-60% से. Look at the stock price, ठीक है? Stock price went from how much? 1,300 to almost 8,000, which is 8 baggers, okay? 8,000%. 2024 में, okay? 2024 में why company was growing? Because if you look at it, 2023 से company was consistently growing north of 40%, okay? But what has happened in the past? Stock has almost halved from 8,200 to almost how much? What? 4,000, 5,000. Okay, almost 30% correction. Why this has happened? First of all, expensive valuations. Now valuations, we'll cover valuations going forward because you need to connect valuations with growth. Okay, so for example, now just understand ki why stock is down more than 30-40% is because of this right here. What can you see? Company that was once growing at north of 50-60%, almost 50-60%. Now its growth has come down to what? Less than 20%. Market will be like, boss, one time you used to grow at 60%. Now you're saying you'll grow at less than 20%. Market will absolutely not reward it, right? Now company will say, now interesting thing is ki management will go forward and say ki we are doing cost optimization, we are focusing more on margins. Why? Because company cannot grow sales, right? Now you can see there is higher base, company has become too big, but that is entirely dependent on context, right? What I said, we don't want to generalize anything. If we see that trend is growing at a faster pace than V2 retail, market will reward trend, and market did reward. If V2 retail is growing at faster pace, market will reward V2 retail, irrespective of Tata Group or anything. Market will reward V2 retail, and it has done, right? If you look at it, trend which was first growing at 70, 80%, it has now come down to 38%, and management is saying that we will grow around 20%. 20% of growth for this company is like peanuts in this company, right? This company which was once growing at 50%, it is now growing at 34%, 27%, and 18%. And now interesting thing is key, why I always say track companies is because if you were an investor and you saw in this con call, and in December or September con call, management said we will not be growing at the same pace. And if you look at it, company which was once growing at 40-50% showed 40% sales growth. Okay, 40% not bad, I'll take 40%. If company is growing 50-60%, say, one quarter there can be here and there. What happened after that? Company showed 34% revenue growth. Okay, signs of alert. Then company showed less than 30% growth. I don't care about demand, I don't care about any problem that is going on. All I can see at face value is that sales ka growth. If company was growing at 60k speed, say, now company is growing at 20k speed, say, right? I don't want that. Okay, if that is why I always say track companies, because you in 2022 you must have seen companies growing 60%. I will hold this, I will compulsorily hold the stock for 5 years and I will make money. What happened? You did make money, but you also lost 30% of it. Why? Because sales growth, company was growing at sales growth, it is not able to maintain that same sales growth, right? So if you were an active investor, you would have exited somewhere around September to December when the price was close to what? 6,000, 7,000. But now you're forced to hold the stock, and you must hope, you must bet on the management that something will happen in the company, and then company will again start growing at 40-50%, then market will start rewarding it. But until then, you have misallocated your capital. Okay? So if you look at companies now not even growing at 20%, means like this is a joke. Why will I even stay with Trent when I've got V2 retail which is consistently growing at what, how much, north of 50%? You tell me guys, which company will you stay with? Simple answer, right? You will always stay with V2 retail. Why would you go to Trent? We'll look at valuations and margins in different video, but for now I'm sure you must have understood why we use sales growth to analyze different peers within the same sector. Now another homework that you guys can do is look at the jewelry space, or look at the IT companies. Why IT companies? Some companies have made wealth in the past whereas some have not. Okay? Look at the capital goods player. Why some companies have made good profits, or companies have made good money whereas some have not. So just to summarize all that we learned in the video, what we looked at: first we looked at why we look at sales growth, why we look at the car race analogy to distinguish peers within the same sector, or to pick the winning stock out of the entire herd. Why? Because in F1 racing as well, we want the car that is growing, that car that is racing at the fastest speed. We want stocks that are growing at the fastest pace. We also discussed the reasons: higher demand, good satisfaction, good market share. Okay. Then also what we saw the gold jewelry companies made by Titan or Senko they have made money, but why some companies have made more money in the past. Then also we look at the retail apparel space, and we understood why some company has made wealth and is consistently making wealth, whereas some company had made wealth in the past but now it is down 40%. For example, Trent. We looked at all these factors, and I'm sure after watching this video you guys have now completely understood the sales growth, and this video marks the end of the sales growth topic. I'm sure you understand sales growth, volume growth, value growth, how to look at sales growth year on year, quarter on quarter, how to look at sales growth within different peers. For example, V2 retail, Bazaar style, Trent, then your VMart retail, how to do a peer-to-peer comparison within the same sector. So that was it for today's video from my end, guys. I hope you guys liked the video. I'm sure you guys have understood the car race analogy, and you've understood why we look at sales growth as the most important factor. And if you found this video informative, make sure to like, comment, and also subscribe to the channel to remain part of this journey, and also share with your friends who are interested in investing and learning more about this stuff. So thank you for watching this video, guys, and I'll see you in the next one. Thank you.